Hello and welcome to the special coverage of the RBI MPC policy meeting outcome. I'm Surabhi Upadhyay, and it has been an extremely busy week, a Friday where bulls and bears on Dalal Street and Mint Street will probably be saying, thank God it's Friday. The week started off, of course, with the union budget. Then we had the trade deal done. The tremors in the international markets around, of course, global IT stocks and the whole AI trade. And finally, we're wrapping it up off with the RBI policy action. So the news from the equity street is that markets have been under pressure. There's a decline of about 0.5% to about a 1% downward move, depending on which index you're looking at. But as far as the bond street is concerned, there's been consistent pressure there. Bond yields, of course, inched higher right after the budget announcement, and they cooled off a little bit. And this morning as well, they continue to be extremely range bound. Okay, well, on that note, let's move on and bring in our set of guests to talk about what the big expectations are from the central bank this Friday morning. We've got Ritesh Nambiar, head of fixed income at Motilal Oswal Private Wealth, joining in. Ritesh, thank you so much for being with us. Good morning to you. So a lot of people are saying, status quo, no changes, because we've already got 125 basis points rate cuts already from last February to now. What's your expectation?
Right. So, Surabhi, clearly we are also in the camp of consensus. The main problem for our market is not the rates, is the transmission of rates into capital market instruments and the other set of lending rates. So, liquidity is paramount. So, if you see from a very high surplus liquidity where we were in June, July, we had a kind of a very drawdown of surplus liquidity up till December, and somewhere in Jan we turned deficit, and that's why RBI had to do confluence of measures through open market operations, FX swaps, and through the VRR route in order to address that. And that problem, if you see from a overnight rate perspective, is kind of addressed because the overnight rates have kind of cooled off by about 70.
Ritesh, yeah, go on. I mean, you're talking about really. So let's talk liquidity first in the market, because what the RBI has done in the last many months, it has injected durable liquidity. We've seen that large FX swap. So first of all, as of today, how do you, and then the CRR cut, remember, in September as well. So series of measures of the last couple of quarters. How do you rate the liquidity position in the market as of now?
So as of now, the liquidity seems to have kind of settled, but the market is looking for several such measures right up till March end, because you would have series of, I would say, period when there would be tax outflows, there would be, in fact, build-up of government cash balances in order to kind of address the fiscal deficit, the overall FY26 fiscal deficit. So I guess RBI will have to kind of be more proactive. So what happened in end December and end January, they will have to make sure that doesn't recur. And because it's I would say it's a Q4, and you have heightened possibility of credit growth increasing, that means that RBI will have to be quite pretty active to make sure that the overnight corridor doesn't really come or be higher than the policy rate, which briefly it was during that when the system liquidity was in deficit.
So Ritesh, would you be expecting more liquidity measures today? And remember, this is just to tide over the remainder of FY26. And then, of course, FY27, we're dealing with that gross borrowing number that spooked the market, Sunday onwards. So what more on liquidity?
So on liquidity, clearly, if you see, I would say, assuming that rest of even in March, RBI is expected to kind of continue with the open market operation. Nearly about 8 lakh crore of open market operations RBI would have done, which is broadly more than 50% of the gross borrowing for last year, FY26. So this time around, in fact, for FY27, the expectations would be on a percentage term similar, because in order to address that demand supply gap, it has to, in fact, that number has to go further high. Second is in the budget numbers, there was no mention of a buyback or a switch. So, which in fact for last 2 years was oscillating in the range of 80,000 to 90,000 odd crores. So that is the excess supply which has come in the gross borrowing number. So there is flexibility for the RBI to kind of address the gross borrowing of 17.2. So the difference versus the market expectation was about 80,000 to about 1 trillion. So that gap can be bridged through buybacks.
Okay, so maybe buybacks to that extent. You're absolutely right. I think the consensus that we also picked out just before the budget, the expectation was that they'll do about 16 lakh crores, maybe 16.1, 16.2. What was announced was 17.2. Hold that thought. We have Deopam Chaudhary, Chief Economist at Piramal Finance, also joining into the conversation this morning. Thank you so much, Mr. Chaudhary, for being with us. Good to have you in. So the question really is, does the RBI need to do anything right now? Because some of our biggest data points themselves will undergo a change, right? CPI, GDP, the series is undergoing a change. So what would your expectations be for today?
All the starts.
I think you're on mute. Yeah, we can hear you now. Yeah.
Okay. So I think, thank you for having me on the show, Shri. So I think this is after a long time that all the stars, all the money market stars have aligned in favor of a RBI policy, be it the call rates, be it the 10-year yields, be it the liquidity situation, and be it the USD INR situation. So it's a good time to do it's no longer a very vulnerable situation that the Indian debt or money markets are facing. But a lot has to do with the faith that these markets have put on RBI, believing that whatever might come, the RBI is there to provide support. There was some amount of weakness in this faith, as my previous speaker was also mentioning, because of the lack of transmission, because of the fact that towards December, early January, we saw some amount of liquidity drying up, which led to further steepening in the yield curve, which led to the call rates shooting much way above the repo rate. But those things are behind us again because the market believes RBI is going to do whatever it takes. Now, if RBI does it, then this situation is going to prevail, and all the good things about the economic development and growth that we have heard in the budget will become easy to attain for the government as well as for the private sector. But if RBI doesn't follow through throughout the year, then there can be a problem. My personal expectation is this year we are going to see another 50 basis point of rate cuts. Perhaps not in this policy. If it happens, well and good. But definitely in the April policy, and then again later in the second half of this calendar year, it will be topped up with another 25 basis point, along with whatever liquidity support that is needed. That the RBI has been giving with 2.5 lakh of surplus liquidity as we speak today. So this is where I am, Shri.
Okay. What about rate cuts? Very quickly, we have 10 seconds left before the announcement, Deopam. Rate cuts, 125 basis points done. Should we expect any more at all?
50 basis points more rate cut this calendar year. Whether it happens, the first one happens today or not is dicey, but definitely in the next one. Because the transmission in PSU bank, MCLR and debt yields have been very, very low. So we need more of the transmission and hence we need more of rate cuts.
Okay, I think the RBI governor has started his address. Let's go.
This year and beyond. With the signing of a landmark trade deal with the European Union and the US trade agreement in sight, growth momentum is likely to be sustained for a longer period. Global growth, supported by tech investments, accommodative financial conditions, and large-scale fiscal stimulus, is expected to be marginally stronger this year than projected earlier. However, the confluence of escalating geopolitical frictions and rising trade tensions is unraveling the existing world economic order. Inflation outcomes are heterogeneous across jurisdictions, remaining above target in most advanced economies, prompting divergence in monetary policy actions as central banks near the end of their current easing cycles. Against a global backdrop that has increasingly become more cautious, bond market sentiments remain bearish, reflecting fiscal sustainability concerns. However, equity markets driven by tech stocks remain upbeat. Monetary Policy Committee met on 4th, 5th, and today to deliberate and decide on the policy repo rate after a detailed assessment of the evolving macroeconomic conditions and the economic outlook. The MPC voted unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the MPC's decisions. The MPC noted that since the last policy meeting, external headwinds have intensified, though the successful completion of trade deals augurs well for the economic outlook. Overall, the near-term domestic inflation and growth outlook remain positive. Headline inflation during November and December remained below the tolerance band of the inflation target. The revised outlook for CPI inflation in Q1 and Q2 of next year at 4% and 4.2%, respectively, revised slightly upwards, continues to be benign and near the inflation target. The slight upward revision in the inflation outlook is primarily due to increase in prices of precious metals, which contribute about 60 to 70 basis points. The underlying inflation continues to be low. On the growth front, economic activity remains resilient. The first advanced estimates suggest continuing growth momentum, driven by domestic factors amidst a challenging external environment. The growth outlook too remains favorable. Based on a comprehensive review of the domestic macroeconomic conditions and the outlook, the MPC therefore was of the view that the current policy rate is appropriate, and accordingly it voted to continue with the existing policy rate. It also agreed to retain the neutral stance. Going forward, the MPC will be guided by the evolving macroeconomic conditions and the outlook, based on the data from the new series in charting out the future course of monetary policy action. You are all aware that in a few days we will have a new series for both GDP as well as inflation. I will now dwell on the assessment of growth and inflation. First, growth. The Indian economy continues on a steady improving trajectory, with real GDP poised to register significant higher growth of 7.4% this year as compared to the previous year. Amidst global headwinds, private consumption and fixed investment both supported growth. Net external demand, however, remained a drag, with imports outpacing exports. On the supply side, growth in real GVA on the back of a strong contribution from the services sector and revival in manufacturing activity is estimated at 7.3% this year. Going forward, economic activity is expected to hold up well in the next year. Agricultural activity will be supported by healthy reservoir levels, robust rabi sowing, and improvement in crop vegetation conditions. Improving corporate sector performance and sustained momentum in informal sector should boost manufacturing activity. Construction sector growth is expected to remain firm. Services sector should continue to be resilient with strengthening domestic demand. Early results from IT firms suggest an improvement in business activity. On the demand side, the momentum in private consumption is expected to sustain next year. Rural demand remains steady with improving agricultural activity and rural labor market conditions. Recovery in urban consumption should further strengthen with continued support from GST rationalization and monetary easing, among others. High capacity utilization, accelerating bank credit, conducive financial conditions, and government's continued emphasis on infrastructure should give an impetus to investment activity. Moreover, several measures announced in the budget should be conducive for growth. You are all aware that one of the kartavs, one of the pillars in the budget has been on sustaining growth. The recently concluded India-EU FTA and the prospective India-US trade deal, along with several other trade agreements, will support exports over the medium term. Services exports should remain resilient. The spillovers emanating from geopolitical tensions, volatility in international financial markets, and shifting trade patterns pose risks in the outlook. Taking all these factors into consideration, real GDP growth projections for Q1 and Q2 of next year, that is 2026-27, are revised upwards slightly to 6.9% and 7% respectively. The risks are evenly balanced. I may mention that we are deferring the projections for the full year to the April policy, as the new GDP series will be released later in the month. I now come to inflation. Headline CPI inflation remained low in November and December, even as it firmed up by 1 percentage point in these 2 months. This increase was largely driven by the lower rate of deflation in the food group. Excluding gold, core inflation remained stable at 2.6% in December. Near-term outlook suggests that food supply prospects remain bright on the back of healthy kharif production, sufficient buffer stocks of food grains, favorable rabi sowing, and adequate reservoir levels. Core inflation, barring potential volatility induced by prices of precious metals, is expected to be range-bound. Geopolitical uncertainty, coupled with volatility in energy prices and adverse weather events, pose upside risks to inflation. In terms of the headline inflation trajectory, despite the anticipated momentum being muted, unfavorable base effects stemming from large decline in prices observed during Q4 of last year, that is 2024-25, would lead to an uptick in year-on-year inflation in Q4 this year. Considering all these factors, CPI inflation for this year, the current year 2025-26, is now projected at 2.1%, with Q4 at 3.2%. CPI inflation for Q1 and Q2 next year are projected at 4% and 4.2% respectively. Excluding precious metals, the underlying inflation pressures remain muted. The risks are evenly balanced. Again, in view of the impending release of the new CPI series on February 12, as I mentioned for growth, we will be presenting our CPI inflation projections for the full year 2026-27 in our next policy statement in April. I will now be talking about the external sector. Despite heightened uncertainty, global trade remained relatively robust. India's merchandise exports, supported by trade diversification efforts, grew by 1.9% year-on-year in Q3 25-26. Merchandise imports grew by 7.9% during the same period, resulting in a widening of the trade deficit. Robust services exports and healthy inward remittance receipts would, however, keep India's current account deficit for the current year moderate and sustainable. Moreover, India's proactive efforts in pursuing bilateral and regional trade agreements with major trading partners are expected to boost international trade and investment, diversify trading partners, and integrate India into global value chains. On the external financing side, gross FDI to India increased at a robust pace during April to November 2025, for which we have data till now. Net FDI too increased as repatriations declined despite a rise in outward FDI. India continues to remain an attractive FDI destination for greenfield projects, as evidenced by a number of announcements made in this regard. However, FPI of 5.8 billion US dollars till February 3 this year. As on 30th January 2026, India's foreign exchange reserves stood at a very healthy 723.8 billion US dollars, providing a merchandise import cover of more than 11 months. Overall, India's external sector remains resilient. We are very confident of meeting our external financing requirements comfortably. Now I'll be speaking about the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, which is the Liquidity Adjustment Facility, stood at a surplus of 70,000 crore on a daily average basis since the last MPC meeting in December 2025. There has, however, been an uptick, I may mention, in February, and now it is almost 2 lakh crore rupees. The Reserve Bank undertook several measures to provide durable liquidity in December and January. Based on assessment of systemic liquidity and its outlook, we announced and undertook further durable liquidity augmenting measures in the second half of January and February 2026. In response to the cumulative 125 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks has declined over this period till December, for which we have data till now, by about 105 basis points. I may mention that the interest rate effect is 94 basis points. Similarly, the weighted average domestic term deposit rate on an average on fresh deposits declined by 95 basis points. This decrease on an outstanding deposit basis is 41 basis points over the same period. Coming to money markets, especially for CPs and CDs, that is commercial papers and certificates of deposits, the rates tightened in January 2026 after softening till December as a result of moderation, as a result of various factors, including moderation in surplus liquidity, excess supply from bunching of redemptions in CPs and CDs in January, and then there is always the year-end effect in the last quarter of the year. G-Sec yields mirroring global trends have continued to harden over the last 8 months due to a host of factors. Going ahead, the Reserve Bank will remain proactive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy and to facilitate monetary policy transmission. Liquidity management would be preemptive, with sufficient allowance for unanticipated fluctuations in government balances, changes in currency in circulation, and forex intervention, etc. I'll now talk about financial stability. The system-level financial stability parameters related to capital adequacy, liquidity, asset quality, and profitability of scheduled commercial banks continue to remain robust. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital position and improved asset quality. As per latest available data, credit from all sources, it has picked up. It grew at 13.8% as compared to 11.6%. A year ago, it had even come down to 9% in May. Bank credit too recorded an uptick in recent months. This growth is supported by sustained lending to all sectors, particularly retail, services, and MSMEs. Large industries also recorded higher credit growth. Now, as has been the practice, I shall be announcing several measures which aim broadly to enhance, number 1, customer protection, number 2, advance financial inclusion, 3, enhance the flow of credit, 4, strengthen the UCBs, promote ease of doing business, especially for NBFCs, and deepen the financial markets. For customer protection, we will issue 3 draft guidelines, 1 related to mis-selling, this has been in the works for some time, 2 regarding recovery of loans and engagement of recovery agents, 3 on limiting liability of customers in unauthorized electronic banking transactions. It is also proposed to introduce a framework to compensate customers up to an amount of 25,000 for losses incurred in small value fraudulent transactions. You are all aware that there has been a number of fraudulent transactions for which RBI has taken a number of measures, and we will again in this regard we also now wish to publish a discussion paper on possible measures to enhance the safety of digital payments. Such measures may include lagged credits and additional authentication for specific classes of users like senior citizens. In the financial inclusion space, we have comprehensively reviewed 3 schemes, the lead bank scheme, the Kisan credit card scheme, and the business correspondent model. We shall issue draft revised guidelines with respect to each one of them. It is also proposed to launch a unified portal for better management of the lead bank scheme data. The limit of 10 lakh rupees for collateral-free loans to MSMEs is proposed to be increased to 20 lakh rupees. This limit has been there for quite some time. Coming to the real estate sector, To further promote financing to real estate sector, it is proposed to allow banks to lend to REITs with certain prudential safeguards. I may mention that lending to InvITs, which are similar in structure to REITs, is already allowed. Now I have 4 measures for the urban cooperative banks. They are an important link in our financial inclusion effort. The first 2 pertain to raising the financial limits on unsecured loans and loans to nominal members by the UCBs. We also propose to remove the tenor and moratorium related requirements on housing loans given by Tier 3 and Tier 4 UCBs. And to strengthen the managerial and technical capacity of the UCBs, we shall launch a mission which we call Saksham, which stands for Sahakari Bank Kshamata Nirman. This mission intends to train over 1,40,000 participants, officials, members, directors from the UCBs. Now come to NBFCs. There are 2 measures for them. NBFCs having no access to public funds and having no customer interface with an asset size not exceeding 1,000 crore rupees are proposed to be exempted from the requirement of registration with the Reserve Bank. Moreover, it is proposed to dispense with the requirement for certain NBFCs to obtain prior approval to open more than 1,000 branches. Coming to financial markets, you are aware we had earlier issued revised draft regulations for ECBs, that is external commercial borrowings. These regulations have been finalized. They shall be issued shortly. We also propose to remove the limit of 2.5 lakh crore rupees for investments under the voluntary retention route. Investment through this route, that is the voluntary retention route, in each category of securities, central government securities, state government securities, corporate bonds, will be subject to the investment ceiling for the respective category under the general route. Furthermore, in pursuance of the announcement made by the Finance Minister in the Union Budget of 2026-27, we propose to issue the regulatory framework for derivatives on corporate bond indices and total return swaps on corporate bonds. It is also proposed to issue draft revised guidelines for authorized dealer banks and standalone primary dealers, allowing them more flexibility in undertaking foreign exchange transactions. Now, before I conclude, I would like to inform that Reserve Bank observes the Financial Literacy Week every year on specific themes of financial education. The campaign this year will be launched on 9th February, Monday, coming week. In continuation of our ongoing endeavor on re-KYC of bank accounts, you are aware that we had launched a campaign for re-KYC and financial inclusion earlier this financial year. The theme that we have chosen for this year's Financial Literacy Week is KYC, your first step to safe banking. I urge all banks as well as participants to actively take part in this campaign. To conclude, the Indian economy continues to register high growth despite a challenging external environment clouded by geopolitical uncertainties. Benign inflation provides the leeway to remain growth supportive while preserving financial stability. We remain committed to meet the productive requirements of the economy and sustain the growth momentum. Thank you, Namaskar, and Jai Hind.
it's very, very clearly evident. The yields have hardened quite a bit because of the lack of any fresh liquidity announcements, no fresh liquidity measures. There is a promise, of course, that the approach towards liquidity management will continue to be proactive. And he has acknowledged that in the last quarter, typically, surplus liquidity reduces. There are, system-led requirements, and the RBI is going to be cognizant of that. No, full year outlook on inflation or on growth, which, is a long expected line. It's very rational to expect that. That's because we have the revision in the data series itself, the GDP series as well as the CPI series. So the governor has pushed back full year FY27 projections to the April policy, when the RBI will have a visibility on the new data series. However, a mild upward revision in inflation for the next couple of months. So for the fourth quarter itself, the estimate, instead of 2% over the full year FY26, inflation was estimated to be at 2%. Now that estimate has been bumped up slightly to 2.1%. And for the coming 2 quarters, Q1 of FY27 and Q2 of FY27, the inflation estimate has been raised slightly. Q1, the inflation estimate is at 4%. And Q2 at 4.2%. And of course, no change in interest rates, as was largely expected. Okay, let's go back to our guests. Let's see, I think we've got Ritesh with us. Ritesh, so first thoughts, what did you make of it?
See, steps were on expected lines. The only disappointment for the market was a couple of things. One is, of course, some reiteration that RBI would continue with the liquidity measures going ahead into March. So that didn't come out very clearly. And second is, again, broadly, the revision in the inflation target. That, again, market will kind of second guess whether it's on the new series or it's on the old series, because as it looks like it's on the old series, and in the new series, because the food weight is getting reduced, anywhere from 30 to 50 basis addition would potentially happen into the new series. So that's the worry point which market had, these couple of worry points. And going into the policy, there was a brief rally which happened post the budget, even on the long side. So some unwinding of position would have happened during the policy.
No, absolutely. I can go back and let's just check the yields. Let's get the yields in the rupee back up, because there was a very sharp reaction in the bond market because of the fact that those liquidity announcements were missing. There was comfort and promise that we'll remain agile and do what is needed, but nothing specific. So let's take a look at the 10-year yield. Yeah, it continues to be in that vicinity of 6.68. So, there is a hardening of a couple of basis points compared to yesterday's close. On Ritesh, on growth, what did you make of some of the announcements? We got some numbers, 7.3, 7.4, but full year projections, we'll have to wait. What did you make of that?
See, the new series is expected to hit this month. By 27th of Feb, the new series would come. Most of the real GDP indicators was kind of skewed on account of the GDP deflator, which is the inflation part of it. So there is a lot of work which the Statistical Institute has put into, and the deflator this time around could be much better, and components of service is expected to be incorporated on that index pretty well. So I guess the derivation of the real GDP would be much better. So that's why RBI has kind of held on with the full year number.
There was some mention, obviously, good news for REITs and InvITs. There was a little bit of a perk up on those listed names. Names like Nexus Select Trust, Brookfield REIT. There's no big move, but favorable announcements coming in that banks with the requisite guardrails will be allowed to lend to REITs, like how they can lend to InvITs. Ritesh, so on inflation, there is a marginal bump up on the estimates for Q1 and Q2, but I guess along expected lines, right? We've seen the best of inflation, I guess, already. It was always expected to start inching up as we enter next year. Where are you on those estimates? And on rate cuts, or rates themselves, do you still hold the hope that maybe at some point in FY27 we will get more cuts?
So on inflation, couple of things. So one is clearly we had a very strong base effect kind of fading off coming into Feb, March, April, May. So there automatically the expectation is that inflation is expected to head higher. So even the Q3 projection of RBI, the actual reading was in fact higher by about 10-15 basis point. So the revisions, as you said, was expected, but clearly the market expected that this could happen potentially in the next policy, not in this policy, because there will be more clarity by then. But I guess on the policy side, clearly for me, even the cues from global markets needs to be kind of accounted for. So ECB's language of further rate cuts not happening, and Fed clearly as of now, market is expecting about two and a half cuts of 25 basis point for the calendar year. We'll have to see, because of change of guard, what really changes. And if that happens, maybe at margin you could get another rate cut. But RBI has the time to wait it out. Clearly, some of the measures from the government on the growth side, as RBI has put in the opening statement, is expected to kick in more so in Q4 and in the rest, I would say, in H1 of next year. So those will help growth.
Okay. By the way, I must point out that the equity market has gone back into its slump mode. It's not such a fantastic Friday for equities. Bond yields anyway have been strengthening. The bank nifty is now at the session lows, the morning lows. It's down about it's down about 0.5%, as is the nifty. Let's get some of those equity rates as well on your screen, and keep you updated on the bond as well under pressure. The nifty right now is down about 134 points. Hamsani is with me now in the studio to make sense of everything that we heard. Very quiet policy, compared to what we're used to, right? The fireworks show from the RBI, but he was holding his fire today, I guess.
Yeah. The interesting takeaway, Surbi, was that I think RBI is also now in a wait and watch kind of stance. Clearly, they don't want to do anything big bang till the time that we have the new series. And my own estimate, the way he spoke about some of the bilateral deals getting done and all that, is that even once the new series is out, he may want to see how the numbers play out. So yes, there could be another rate cut down the line, another 25 or 50 basis points depending on how really growth takes on from here on, but nothing really in the hurry. The fact that the RBI continued to press on the neutral stance, continued their commentary as well, to sort of say that we will give you liquidity, but just as much that you need to sort of push the pedal on growth. So we're not being promised excessive liquidity. That's also reflecting somewhere in now bonds and rupees also moving. Another interesting takeaway, he made a very specific mention this time around to say that, there is demand from large corporates for loans. I see that as a major positive, and this is also the first time the RBI has acknowledged something like that. Are we at the start of a good full-blown corporate cycle, corporate lending cycle? That is something we need to watch out for. It's a very good thing if that does play out, but at the moment, as you did rightly point out, it's quite a quiet RBI MPC as we go to the close of the year, and one where we did not have much of promise as far as liquidity is concerned, not much of promise as to where the pockets of growth is expected and all that. Commentary on that, possibly we'll try to get something out from him in the press conference. The point on ECB is also quite valid. We'll have to see how the fine prints come. Is that going to make once again overseas market attractive to the thresholds that one can look at? Mind you, until about a year back, ECB was a very active route for NBFCs to go and get money. We'll watch out for some of this. The question which I think most reporters would be asking or throwing the governor is what on liquidity, because transmission has happened on the bank lending rates.
And he gave some stats on that.
Yes. Yes.
to what extent on the borrowing side and on
Pretty
the
much
lending side? Yeah.
similar to the stats that we're used to seeing up until now. I don't think there's a great change in the numbers in terms of how the weighted average either borrowing rates or deposit rates have really moved. In fact, should be on the deposits, I'd like to point out an interesting stat here. Although at the lowest end of deposits, banks are saying that, a lot of transmission is happening, we're able to push through rates, we're able to bring down rates, etc. The fact is that at the medium bulge, the bulge at which you and I would really go and chase bank deposits as retail depositors, that is still under pressure for banks. There, they're not able to really tinker with rates because the alternatives are high in number, and as well as the fact that, whatever rates which is being, secularly offered, it's not attractive enough for a retail depositor to participate in the bank deposit story just yet. So these are some of the questions we'll put forth to him. This time also, if you notice, he kept on harping about the impact of volatile precious metals. That is a very interesting thing. I haven't heard him, press so much on precious metals, namely gold and silver, up until now. That's another thing we'll sort of watch out for.
He did take note of the volatility in the precious metals market. So I think this is just a bit of a quieter policy till we get to the full-blown action perhaps in April. It's very, very clear.
I would think maybe the time for us to get to a full-blown action would possibly even be up to June, July. I don't see anything in the interim till now.
Any major moves. All right, Hamsini, thank you very much for that quick initial take on what we've heard. Final comments from Ritesh as well, and we have Madhavi Arora now joining into the conversation. Ritesh, from an investor's perspective and someone who's been watching these bond yields harden, what is your sense? What are we in for till we have all the evidence and maybe clearer action from the central bank? Either it's in April or maybe in June, as my colleague said. What's your advice to fixed income investors and the general sense that you have on yields from here on?
Right. So I would say since June, we have been kind of propagating investing into 1 to 3 year kind of papers, because the reaction which we saw across short as well as on long rates, we were of an expectation that there was an fronting or the preempting of RBI actions which happened then. And we continue to hold on to that position clearly on the shorter end side. Clearly, the investor should look for maximizing the yields, because that would be major form of your return, because returns would predominantly come from accrual and lesser from capital gains. Somehow the reaction which we have seen in the GSEC, especially on the long end part of the GSEC, we expect that valuations have become pretty attractive on the long end of the GSEC. So I would say somewhere, around early March, when clearly most of the negatives of the SDL auctions would be through us and the actions from the RBI would be much more clearer, there is a potential possibility that some investors can tactically allocate some position into the long end rates.
Okay. All right, Ritesh, thanks very much for being with us. Really value your inputs. Very helpful for our viewers to understand what the announcements really mean for them today. Thank you for joining in. Have a great day. Well, let's talk macros as well. And, what have we learned with the RBI's interpretation of the overall environment? We have Madhavi Arora joining in from MK. Madhavi, thank you so much. Good to have you with us this morning. So, we're none the wiser when it comes to full year projections on either GDP or inflation. But what did you make of the announcements, and what was your main takeaway?
Surbi, I think you have largely covered a large chunk of the movement in terms of policy understanding. But just to add, I think, the Reserve Bank is anyway sort of trying to figure out whether the kind of macro dynamics that played out last year would probably repeat. As of now, we don't seem that would be the case. To a large extent, inflation is likely to go up. Even if you adjust for the gold factor, I think the commodity markets are looking to be sort of more steady. So I think on a Y-on-Y basis, you will see inflation steadily going up, even though it may not exceed more than 4.5%. I think growth would be a bigger lever for me to think of the policy making incrementally. But otherwise, from the macro point of view, I think to a large extent we are stable next 6.
Yeah. Go on, Madhvi. Sorry, we lost your audio for a second over there. On the liquidity front in particular, on liquidity, I mean, that's where the market's disappointment seems to be, given that big gross borrowing number for next year. What else would you like to hear, perhaps over the next few weeks from the central bank?
Done their bit. If you look at the RBI, they've almost bought 68% of this year's net government borrowing. So, they've largely financed the government of India. So, the market can't be expecting the Reserve Bank to bail out. Otherwise, there's no need for a market in the first place, right? Deficit financing can be just done between Government of India and the Reserve Bank of India. There's a reason why markets exist. So I think to a large extent, markets have become relatively more complacent, which is not how we want the economy to be. This is how what you would want the Reserve Bank to bail out the market participants on a regular basis. I think incrementally, there may not be much of a liquidity lever that you will see from the Reserve Bank for this quarter per se. Assuming that we may not have much of a requirement of FX intervention from the RBI, currency circulation may ease at the margin from the last quarter. Thus, the government spending will come into action, which will imply that by the end of the year, with whatever the RBI has done in this quarter so far, which is 4.5 lakh crore of liquidity infusion, by the end of the year, we'll be somewhere close to 1% of NDTL worth of liquidity. I think to that extent, I don't see much of a reason as to why RBI should infuse more. But I would still be, trying to understand how the market dynamics play out, because what we are seeing over the last 1 month or so is that the market sort of, continue to remain in stress, especially in the money market space where CD rates have gone up dramatically. Bond yields have remained high. The yield curve remains extremely bearish, and bear steepening is, a theme which has been running for the last 6 months or so, and it may continue in the next 6 months as well. So I think you are in for a rangy GSEC market. Even if they had cut the rates today, markets would have generally probably sold off any which way. So.
Okay, all right, Madhvi, we'll let you go. I think you're on the move, so we'll let you go about your day. Thank you very much for that quick take, quite helpful for us, and hope to chat again soon. That's a view from MK coming in. Let's go back to the markets and see what's happening on the screen. The equity market is really feeling the reds today, not the blues, but the reds. And for that, you have largely, the global situation to blame. There's too much of volatility. We've seen a complete risk-off in global markets, whether it's global equity starting with the US, whether it's, the precious metal space. And of course, the IT turbulence continues. Remember today, markets like South Korea sold off about 5%. So that in any case is a headache for equity markets. And add to that the fact that the RBI hasn't delivered anything new or anything more comforting on the liquidity front, which is why yields have been under pressure. But to be fair, the RBI has promised, saying that we will be coming back with measures as needed, and the liquidity management approach is going to be very proactive. So it's one can argue it's not really the RBI's job to give comfort to the equity market, is it? But in any case, as we are seeing the equity screen right now, there is a sell-off that is underway. The Bank Nifty is now at the morning lows. Bank Nifty is down about 0.6% as we speak. The mid-cap index is sliding a little more. The mid-cap index is down about 1.2%, and that's the Nifty itself. Nifty is actually looking better. The slide is far more clear on the mid-cap side of the market, and the Bank Nifty is showing up that disappointment because rising yields and lower bond prices are not good news for bank stocks, and that's what's playing out. Let's actually look at the Nifty losers as well. So there are two pockets to this. Today, IT is weak and banking is weak. The twin engines are down for the bulls. So in terms of Nifty losers, you'll see names like TCS, you'll see names like SBI, Tech Mahindra, Infosys is down. So like I'm saying, IT and banks, both on the lower side, and that's really compounding the problem for the bulls today. Other weak names include some of the consumer names like, Trent is cooling off after yesterday. There's Nestle on the lower side of the screen. So that's where the large cap pressure is really coming in. Talking about banks specifically, let's look at HDFC Bank. It's down about 1%. ICICI Bank is actually still positive. You have Axis Bank, which is up about 0.25%. SBI actually is the one that's down a lot. It's pulling down the Bank Nifty. It's down about 2% as we speak. That's State Bank of India. Then, of course, you have the wider sell-off in the broader markets. and plenty of names there. Hexaware, for instance, yesterday's result casualty, again down about 4-5% today. Canes, down about numbers, down after numbers, down about 4-5% as well. Short point, markets not feeling too good. And actually, as I introduce our next guest on the show, let's see what the Nifty's done for the week. Most eventful week. For what it's worth, the Nifty's up about 0.75% so far this Friday morning. Well, let's get to the market perspective. Then we have Ajay Srivastava of Dimensions joining in for his take on the policy and the policy and beyond. Ajay, what a week. I think everyone is just waiting for 3:30 this Friday afternoon, I think. Ajay? Okay, I think there's a issue with the technicals over there. We'll get him back. All right. So, like I was saying, let's look at some of the losers and really where the pain points are in the broader markets. Now, if I talk about the stocks which are moving down on big volumes, then Hindustan Copper, some of this unwinding in metal stocks, that's been the hallmark of this week and that's continuing today. Hindustan Copper, by the way, for the week is down 15% and is down about 5% this morning as well. Then you have the financials, Manappuram, REC, a couple of these names are down. There is also from the metal space again, there's Nalco, which is down about 4%. So these are some of the stocks on the way down as we speak. Other losers of the day, more IT names really coming up on the downside. There's Cyient, which is lower by about 5%. There is AB Fashions, which is lower. Avanti Feeds, earlier in the week when the trade deal was announced, some of these shrimp stocks, these export-oriented stocks, they had a massive pullback rally. But today is a day of cool-off as the market sentiment remains fairly cautious, to say the least. I'm not saying fragile, but cautious for sure. The mid-cap index is down about 1.25%. For the week, I told you the Nifty is up 0.7%. Let's check the mid-cap index. Mid-cap index is, for the week, is actually up just about 0.5%. So the caution is creeping back in the mid-cap market. There's no taking away from that. And today, by the way, the advanced decline ratio is also quite negative. You have over 2,000 stocks declining on the NSE this morning, and the declining stocks are at about 650. Well, with that, we'll call it a day on our RBI special coverage. So just to recap, no change in rates. The market is disappointed that there are no fresh liquidity measures because that is what the market was hoping for. But the RBI seems to have deferred a lot of it for the April policy while maintaining that they will be very proactive in terms of liquidity management. The full year outlook for inflation and for GDP FY27 that has also been pushed back to the April policy once the new series is out. So that's the RBI announcement. Thank you so much for being with us, and we'll keep getting you more updates through the course of the day. Thank you for watching.